Robert Kiyosaki, who wrote Rich Dad, Poor Dad, said very, very famously, there's only one true way to create wealth, and that's passive income.
If I took $15,000, I put it in the stock market, it would have to make 40% a year to equal what I'm getting with you with a BRRRR in Cleveland.
Boston, New York, Washington, D.C., South Florida is like this. High home prices, low returns. We're in markets that script is flipped, and the lower prices and higher returns.
You can buy $100,000 houses that rent for $1,000 a month or more. And that's the 1% rule.
We have been really active in what I consider the #1 net positive cash flow monthly market in the country.
You know, we had you on last year. I think we talked about turnkey and BRRRR investing.
Yep.
Are you still doing that? Is there a version that's a little bit different? Like, what are you up to this year? Hello and welcome to the Real Estate Doctors Podcast, where I'm here to entertain, inspire, and educate you. Today, we will definitely educate you. We will entertain you because Phil is always entertaining, and maybe I'll try to inspire you. So today, I have Phil Alexander, who has been on the podcast before, but he just popped up in Aruba. I don't know how. And I said, well, if you're here, let's do a podcast. So Phil's second time on the pod. Actually, I think you're the first person to have for the second time. So welcome to the pod, Phil. Phil Alexander with TK Investor Group and Portfolio Properties USA. So Phil, welcome to Aruba.
Thanks, Doc. It's great to be here. No, I was... Actually, I've been kind of around the world. I was in London on Sunday morning, and then all of a sudden I found myself in Boston, and it was like below zero. And I said, this is like not fun. So I said, the thing about planes that I really like, you get on in one place, and you get off in another. And all of a sudden I found myself in Aruba, and you were gracious enough to invite me onto the podcast. But I've got a lot of cool stuff to talk to you about.
Okay. So how many days ago were you in London?
2 days ago.
2 days ago. And then you went to Boston, and now you're in Aruba.
Correct.
Okay. So
Correct.
Obviously our weather is supreme. It's much better
the
here.
best.
So
it's the best.
All right. So Phil, what are you up to? Actually, you know what? Better question. Where are you going next?
Actually, I'm flying in 2 days up to Newark Airport. My youngest daughter, whose half birthday, if you will, I know it's a stupid thing that my two daughters do. They celebrate their half birthday 6 months.
For real?
For real.
I never heard that.
And well, it's just another way to get more gifts. You know, I'm going up to fly into Newark, and she lives in Jersey City, and she and her husband and me. He's a great guy. We're gonna eat well and drink well, and I'll probably get out of Dodge just before the Super Bowl so I can watch it from the comfort of my place in Boston.
Go Eagles, by the way.
You know,
go Eagles.
I've always been a Patrick Mahomes fan, but in this particular case, he's done. He's done.
I hope so. I hope he's not watching. You know, he might be offended. But all right. So, and then you're doing, and like, what are you doing this year? You know, we had you on last year. I think we talked about turnkey and BRRRR investing.
Yep.
Are you still doing that? Is there a version that's a little bit different? Like, what are you up to this year?
Definitely still the BRRRR, which is a blend of the BRRRR, buy, renovate, rent, refinance, repeat. But we do kind of a hand-holding through the process. It's really perfect for new investors. And we walk you through every step. You know, you have the high-touch experience of a turnkey investment with all of the benefits and profits of a BRRRR strategy, which accelerates your investing and portfolio creation. But I've been doing that since before BRRRRs even had an acronym to call it that. And yet, what is so exciting, you know, in this 2024 into now 2025, is we have been really active in what I consider the #1 net positive cash flow monthly market in the country, bar none. You know,
Well, hold on. You got to tell me which one. Where's that?
I'll tell you.
Oh, you were getting there? I'm like, come on, man.
No, what I want to
Wait for it.
Yeah, just wait for a minute, because here's the reality. Anybody who understands the BRRRR strategy knows that it's nothing more than a turnkey on steroids. It accelerates the process. Okay, how does it do that? Because you have kind of a wholesale discount. You're buying the property, you're renovating it. That's the value add, and in doing so, if you've bought the right property, and that's where we come in, you have improved and increased the value of that property, typically 20 to 30%. And then you wait a 6-month seasoning period and you do a cash out refi. And don't believe anybody that tells you you're a failure if you don't get 100% of your cash out. But getting 90% of your cash out, absolutely doable. Absolutely doable. But here's the thing. The market that I'm absolutely in love with right now, and all my clients until it changes, is Cleveland, Ohio. Cleveland, Ohio. Now, my dad was from Cleveland, has nothing to do with it, and besides, he's not with us anymore.
Okay.
But the Rock and Roll Hall of Fame is there, and that's pretty cool. And they even get these really cool, like lake effect snow storms, which I was caught in December. In fact, you were there as well in December. But here's the interesting thing: in a good investor advantage market, East Coast, Midwest, Southeast. Once you have done your BRRRR thing and you've done your cash out refi and you settle into, normalcy, if you will, okay? You're probably looking at $200 to $250 per month net positive cash flow after all direct expenses, including the management, taxes, insurance, and your mortgage payment.
Okay.
$200 to $250. I only have, out of my entire inventory in Cleveland right now, 2 properties that are making less than $500 a month.
That's double.
Absolutely double. And in fact, I've got some properties that go as high into the 700s. It's 3x.
Okay. Okay. I'm familiar with the market, but I think we need to go back a little bit here, and just for people that don't know what a BRRRR is. A BRRRR is a way, and really this is what got me going in social media. I explained what a BRRRR is. A BRRRR is a way to make your money go. Now, Phil doesn't like to say infinitely, because that would mean that you invest in the property and then you get all your money back when you refinance. The general idea is you buy a property, you renovate a property, and then you rent it out, but you go to the bank and the bank gives you 100% of your money back because you created this value. So Phil's saying, don't count on 100%, but 90% is good, because the returns, when you do a calculation, when you get 100% back, there is no calculation, it's infinite. But if you get like 10% back, you can have returns 70, 80% on your money. Now, I really, I love that, but what kind of, you're talking about $500 a month, but what are the prices of a house? Like, what's an example of a price of a house there?
Typically, our properties range from, both the purchase and the renovation, because we use our own crews, we control the cost, and get it done on budget, on time, between $100,000 and $150,000. All in.
All in.
All in. Now, I like to say the best way to understand and enjoy a BRRRR and what it can do for you is you can go through a pro forma. And I know in other podcasts you talked about pro formas and looking at a property and how you can make money with it, and you take the rents and you subtract the direct expenses and all that kind of thing. But here's the cool part, okay? That the reason why my company is in the markets we are, it goes back to when we were kids, and a seesaw relationship that exists between home prices and annual returns, okay? And West Coast, Boston, New York, Washington, D.C., South Florida, is like this: high home prices, low returns. We're in markets where the script is flipped, and the lower prices and higher returns. But the thing that makes Cleveland so incredibly unique is that you've got these lower prices, but real world, very healthy rents. And when you have, just simplistically speaking, that kind of a situation, your returns are off the charts. So what I typically do, Doc, is I will show a person, an investor, what you can make, with the BRRRR. But then I say, well, just out of curiosity, let's see what you would have invested in that property if you had done it as a classic turnkey, where you bought it, renovated and tenanted in place and all that kind of thing. See, you're not getting, when you do a classic turnkey, any built-in equity. Okay? With the BRRRR, you create that equity through the renovation. Okay? And the bottom line is, you're generally talking about 50% of the out-of-pocket expense to do a BRRRR on a property versus if it was a classic turnkey, what you would have spent out of pocket. And it's that together with this healthy rents and low prices that give you this incredible opportunity to make insane money.
Okay, I have a ton of questions here. All right, so we talked about the price. Now, I always talk about the 1% rule, which is like, hey, you buy a property for $100,000. Actually, I had a viral video on that one too. You can buy $100,000 houses that rent for $1,000 a month or more, and that's the 1% rule. So 1% rule is, as you know, you buy a house for $500,000, it'll rent for $5,000 or more per month. $1 million, $10,000 or more per month, $100,000, $1,000. So does Cleveland beat the 1% rule?
More than beats it. More than in fact, it beats it from the perspective of what your actual expenditure is to purchase the property and then renovate it. And it also beats it when you look at the expected appraised value or the after repair value. So you're covered.
Okay.
It's incredible.
So now you talk about like inventory that you have, and I have some students that I buy in Cleveland myself, and I have students that buy in Cleveland. And it's hard to get inventory. So, you have your own inventory in Cleveland, and like, on any given moment, you have how many properties you could?
Typically on average, anywhere from, I'll say 5 to 15. I have
in Cleveland.
In Cleveland.
Wow.
I have my own in-house wholesale unit, which is one source of our properties, but we have good deal flow. We've got a small handful of wholesalers that we've worked with over the years, and they know what we like, we know what they're like, and you put it all together, and we're able to get at any given time 5 to 15, 5 to 10.
Okay, but you're not selling like a turnkey property, like the house is done and rented.
Correct.
You're selling like, hey, buy this, renovate it, but who's going to do my contracting?
Well, and as I mentioned, the beautiful thing about what we do is because, look, the two, I think, biggest pain points, and I think you spoke to this on a previous podcast, is finding the right property. It's easy to find a property, but to find the right property that once renovated is going to have that big uptick in value, that's hard. That's something that we're expert in. I've been doing this for over 20 years, The second pain point for most early investors is the construction element, finding a construction company, trusting a construction company, not getting taken to the cleaners by a construction company. And we're blessed to have a construction crew that, or crews, I should say, that have been with us for years. And, we've got right now 4 crews operating in Cleveland alone, but we're having to increase that, and we're in short order going to have another 4 crews going because the volume of business that we're doing is just crazy.
Okay, so if I buy a house from you, you are going to recommend me a contractor, or has your contractor already been to the house?
No, our contractor's already been to the house. We come up with a detailed and itemized scope of work, for the property. So when you see the pro forma, in which case you see the purchase price and the renovation amount and all that kind of thing, that's set. That's set in granite, if you will. That doesn't change, and we have all the detail of how that money's going to be spent. And we also, and this is the other very important element, we have absolute confidence in the after repair value, as it's sometimes called, ARV, or expected appraised value, because there are two things. Number one, we do it the old-fashioned way, with closed sales comps, and we look hard and make allowances for size and condition. But we have found more and more, and we have lenders that we can introduce to any investor to suit their needs. And we've noticed that a lot of hard money lenders these days are using a special software that really takes the human element out of what could otherwise be a very arbitrary appraisal. And so I said, I don't understand how they do that. And then I realized I can do that. So we went out and bought the software. And so we take the software-driven approach, blend it with the old school approach, and come up with, I think, conservative, but a good number. I think our last client who did a cash-out refi, might have been last week, got an appraisal $10,000 over our estimate.
Over what you estimated before they bought it.
Correct.
Okay, but you bring up something I wasn't even thinking about. So in the typical BRRRR method, you need to have cash, cash money to buy it and renovate it. So now you're talking about hard money. Maybe you want to explain what hard money is.
Sure.
But so you don't need cash to do the BRRRR method?
You do. I mean, my name is not, Grant Cardone. I'm not, I'm not sitting here saying you don't need money to invest. There are ways of getting, private money and so on. But no, typically, Doc, what I say is, if you've got, say, 30,000 liquid, I can get you in the game very nicely. But what hard money is basically it's intended to be short-term, 6 to 12 months max, and the lender will lend you typically 70 to 90% of the purchase price, but it depends on two factors. Number one, any experience that you've had, which makes you a better risk if you've got a lot of experience to the lender, together with what your FICO score happens to be. Most hard money lenders won't even touch you if you're below 660. That's a line in the sand that very few will go beyond. And just FYI, if you're buying, say, as a married couple, maybe your FICO score is 750, but your partner's FICO score is 550. Guess what? You're stuck because they're going to go with the lower of the two FICO scores. Absolutely. Okay. Absolutely. But anyway, so they'll lend you 70 to 90%, and then they'll lend you 100% on the renovation number. But here's the caveat. Number one, you go in draws. You don't just put all the reno money up front. You go in draws. If it was, let's say, $30,000 renovation, maybe you'd have 3 draws of $10,000 each. The lender is going to expect you, even though they're going to lend all $30,000 in the end, they're going to expect you to put up that first draw in cash yourself.
Okay. And
then once the work that's attributed to that first draw is completed, we are well versed in giving the photos and or video to you to give to the lender, who is going to see that the work was done and reimburse you that money. Then you take that money and you recycle it. You turn around and give it to the general contractor for the second draw. When that's done, you roll that over and to the third draw, and then you're set. Typically, the way we work is 2 weeks or so prior to the completion of the renovation, we're going to introduce the investor to a recommended property manager. You don't have to work with them if you don't like them, you know? We don't have a dog in that hunt, so to speak, you know? But it gives you time to interview them, to see how you feel. And then you go ahead, and if you're working with them, then they start marketing your property after you've signed the property management agreement, and they get a good tenant, usually in 2 to 3 weeks.
Okay. Man, you're fast. So you find the deals, and you think that you find good deals, and you're using a software that basically lenders use, so you kind of qualify them with the same software that they are. You have the contractor.
Yep.
Contractor's already been to the house, has an estimate. That in itself is amazing because, you know, it's a pain in the butt to get like people to go out and estimate and negotiate and yada, yada, yada. But you also have the lenders.
Yeah, well, we don't own the lenders, but yeah, you know, as you know, Doc, you know, when you've been in this game a long time, you can't operate in a bubble without the benefit of your clients having lenders to work with. So I have multiple hard money lenders. I've got a crackerjack private lender that, you know, is tough to qualify with.
What is a crackerjack?
That is somebody that'll give you 100% of the purchase and 100% of the rehab. The only caveat is that you've got to get qualified with the lender, number one, and then the property you want to buy has to pass muster with that lender, and they're pretty picky. They're pretty picky.
Okay.
But anyway, so we have those lenders, and all of that is geared towards the person that doesn't have all cash. If you've got all cash, the world is your oyster. You can buy and close quickly, and you don't have any of the expenses, you know, 12 to 15 or so percent interest rate for hard money, or any of their fees, you know, points and otherwise. But at the end of the day, you're still, you know, going to do at 6 months, typically, a cash out refinance. You have two choices. If you haven't used any lending, like a hard money lender, you can do a conventional cash out. But the rules for Fannie Mae and Freddie Mac say that if you've used any lending, that seasoning period is not 6 months, it's now 12 months. So it kind of takes out the benefit of using the hard money lender. All of a sudden, what arrived? A DSCR loan, which stands for Debt Service Coverage Ratio. And in essence, in plain English, it's a loan against the cash flow capability of the house rather than the credibility of the borrower.
Okay. Again, you're super fast. So I just want to lay this out. So you have lenders that will, houses are $100,000 to $150,000.
Correct.
Now, are these, you know, single family houses? You know, what kind of?
Mostly singles. The only drawback, I mean, a lot of people like the idea of a multi, a duplex, a triplex, a fourplex, from the perspective that if you lose one tenant, you're still cash flowing with the other doors. In my opinion, it's kind of like a 50-50 prospect. Personally, I'd rather have a single family that's not going to have a problem because there are plenty of comps to give you a decent appraisal. You know, if in many markets, if you've got a duplex or triplex or fourplex, getting a good comp and appraisal is very difficult because there is a lack or a shortage of closed sales comps of that property type.
Right. Right. So I've definitely seen that single families appraise way better than, you know, a duplex or triplex, any of that stuff. Especially like, you know, if you're an investor, you're buying a duplex or a triplex, you know, you're not selling it. So there is no comps. But, you know, when you are in neighborhoods where people live, there are comps that like these single families. So, okay. So you have lenders that will, so if I want to buy something for $100,000 to $150,000, I can have cash and come talk to you. Or I can use one of your lenders, or I'm sure I can use one of my own lenders but not every lender lends everywhere. So maybe my lender doesn't lend in Ohio. But anyway, you have lenders in Ohio. So how much money, you're saying with $30,000, I should be able to go through the whole process?
Exactly.
Okay.
Exactly. Because, like I said, if you take 100,000, say you have no experience, so they're only going to give you 70% of that. That means they're going to give you not 70% of the 100, it's 70% of the purchase price. Don't forget, you've got purchase and rehab. So maybe it's a $60,000 purchase. They're going to give you 42,000, okay? Which means that 18,000 comes up from your own pocket. Then you've also got to have the first draw of that. Let's say it's 40,000, 4 draws of 10,000 each, and we'll work with you because it's our construction company to make it easy for you to manage. So you've got 18 on the purchase out of your own pocket. Then you've got 10 in the first draw. You'll get that reimbursed, and you don't need that at closing per se, but still, that's 10 that you will have to pay. And then usually there's some costs, some points, maybe 3 points ish, on the whole amount, which could be another few thousand.
Okay. So after I do that, I go through the process. Now, do I have to talk to the contractor?
You can, but it's not mandatory. Why? Because we've got a very detailed and itemized scope of work. You close on a Thursday. If you wire money on a Friday for the first draw, the crew starts work on Friday, demoing your property.
Wow. Okay. All right. Now, you got money for the purchase. I spent like $30,000, and then when I'm done and I want to refinance, you have lenders for that.
I do.
Right.
And so typically at 5 months, because usually you're doing a DSCR or a cash out loan at 6 months. At 5 months, I'm going to introduce you to the lender that's going to do your cash out. And that's because it takes about 30 days for them to do their thing. And just when you hit the 6 months, they do the cash out, we're going shopping again.
For another house.
For your next property.
Right. That's the beauty of the BRRRR method, is you can do it over and over and over again. So if I put $30,000 out, when I go to refinance, am I going to put more money out? Am I going to get that $30,000 back?
No,
What's typical?
Typically, you will have to put some more money out because you will generally always leave some money in the deal. But I think it's important to understand something. You don't get something for nothing. And the bottom line here is, let's say you bought that, not $100,000, maybe it's a $130,000 house, okay, as a turnkey. In other words, it's already been renovated, it's already tenanted, it's already cash flowing, and you buy it. How much is that going to cost you out of pocket? Well, single family, you're going to put 20% down. Right there, that's $26,000. Closing costs, finance fees, another $6,000 at least. So you've got about $32,000, $33,000 out of pocket to be in that house. On the other hand, through the BRRRR method, you probably haven't had, after your cash out refi, you haven't left any more than, say, $15,000 or $16,000 in the deal.
So you mean it will cost me, because my original question was like, am I gonna put out more money or get money back? So net effect is I get money back, but it just costs me money, to do the second loan too.
Well, it does. It does. But the reality is that, you have to assume you're going to leave, I call it leaving some money in the deal. It's an out-of-pocket expense. Okay, which, by the way, controls, if you look at the way to calculate it, your cash-on-cash return, which is the true return based on that total amount out of pocket to buy that property.
Okay, so give me what you're saying is, let me go back. So I'm buying a $150,000 house. I'm $30,000 out of pocket. I go through the process. I refinance. Now I'm only $15,000 out of pocket. Would you say that that is a fair situation, or
Very fair.
okay? So now 15,000. How much money is that 15,000 that I invested? Because really, that's my own. That's my money in the deal. The rest is the bank's, right? How much money is that making?
In Cleveland,
Yeah.
you're talking probably $500 to $600 net per month.
So now you're gonna make me do math. So $500 a month times 12 months is what?
6,000
6,000.
a year.
So 6,000 divided
So
by
you
50.
you know
40%.
theoretically, yeah, and that's the number more than almost any other number that you need to be focused on. You know, cash flow is great, but a strong cash on cash return, which the calculation is if you made 500 per month, right? Multiply it times 12 as you did, that's 6,000. Then you divide that by that out of pocket number that we've been talking about, which is made up of, you know, your closing cost, your finance fee, and generally it's a down payment, but it's what's left after you've done your cash out, the difference between your cost and your cash out amount.
Oh, okay. I'm going to smoke you with a question here, but it's going to be the second question. So basically, what you're saying is, if I took $15,000, I put it in the stock market, it would have to make 40% a year to equal what I'm getting with you with a Berkey in Cleveland, right? Okay.
And that's just on a cash flow basis.
Okay. Oh, but wait, there's more?
Yeah.
Okay, well, I got to remember my question, but go ahead. Don't try to get me off the subject, but go ahead.
Okay, I want to hear that question. But basically, Wall Street, you said put it in the stock market,
Yeah.
has only maximum two ways you can make money. The stock, the bond, the mutual fund can go up or it can go down. And some stocks are what we call blue chip stocks, really good. Maybe it's a mutual fund that pays a dividend. Dividend is the second way you might make money. But guess what? That's it. It doesn't get any better, and it can't get any better. And yeah, it can go down to zero.
This is true.
Okay? And we've seen that. I mean, both of us have been in the business long enough to remember those days. But in real estate, all we've been talking about here is the high cash flow, high cash flow, high cash flow. Okay? And Cleveland is amazing. In my opinion, it's the number one market in the country. But what about the other ways you make money? There's equity growth is the second way. In other words, the tenant pays the rent pays the mortgage. Every month the mortgage is paid, your equity ownership in the property grows. Number three, appreciation. Don't fool yourself. Never chase appreciation. That's what speculators do, not investors. Okay? But here's the caveat. If you are buying in a growth market, you've got the reasonable expectation of appreciation. Now, in Cleveland, properties in 2024 appreciated 7% in Cleveland. I mean,
Okay.
banks aren't even paying that much.
All right. This was, I'm sorry to interrupt you, but this was going to be my question. Okay, it's all great. You know, the cash flow is great, but you're probably buying in the hood and there's no appreciation. If I go and buy in Nashville, I'll get way better appreciation.
No,
No.
no, no.
Okay.
I think Memphis,
Well, which one though?
Memphis and Nashville, 4.5%, 5% appreciation, you know, and I'm not buying in the hood. I mean, look, we borrowed in residential investment properties a system that's been used for, you know, decades, maybe centuries in the commercial real estate world, where they classify properties A, B, C, and D, and so on. They have very clearly defined specifics of what is an A, a B, and so on. It's not as clear with residential, and it kind of is subject to interpretation. My simple understanding is an A neighborhood is the kind of neighborhood that I aspire to live in, you know, that I'd like to live in, you know, really gorgeous homes, high prices, low, if any, returns. Then you've got a B. Now, a B neighborhood is probably where I do live, which is a nice neighborhood, and they, you know, attractive houses, but lower prices, higher return. Remember that seesaw? Now, the investor sweet spot are the C's. Now, those are lower prices still, higher returns, and it's essentially where they're predominantly tenant-occupied neighborhoods, but there are some owners. But it's where you're going to get your maximum return. And what we try to do in those neighborhoods is to buy in an emerging or coming up or upcoming, C to a B, close to a B nearby, but not quite there yet, because that's how you're going to make your most money. And D's, I lock my doors of the car as I'm driving through. That's,
Okay.
We're not investing in those.
So a couple thoughts come. First off, emerging, I like that. So typically in my career, I bought a lot of C's, and if they're close, if you're in a tight city, if they're close to an A, you can get a real pop. It's like, hold on, wait a minute. 4 blocks over here, this is not nice, and over here is beautiful. So that's one. Buying in D's, I am the king of, I have tried so many times, and I have bought in D's, and I could tell stories. So let's just leave it at, because this podcast is your podcast, not mine. This is definitely not what you want to do. I can give you 25 stories about why not to do it, and I've tried. The numbers are attractive. But yeah, I don't know. Lock your doors and keep going. Just avoid the D's.
Yep.
So going back to, so it's crazy. So you're getting cash flow and 7% appreciation.
And the appreciation, your equity is growing, tax benefits. Look, it's a little different for every individual because everybody's got their own particular tax situation. But the one thing that's for sure, you take depreciation alone, and I seem to remember the real estate doctor might be a CPA. So, as such,
Don't tell anybody.
But you get that depreciation, which basically comes. It's spread over years, comes right off your taxes. The fifth way is that it's pretty cool. I mean, by the way, tax benefits. I mean, last person I talked to, was saying, "Hey, I'm off to Bali." I said, "That sounds like a pretty exotic vacation." "Oh no, I'm going to go look at real estate." Okay, noted. They had a nice trip to Bali.
Yeah, write it off.
Yeah.
Yeah.
But the fifth way is one of the coolest and one of the most oblique, really, but it's right there, and that is an inflation hedge. People really get wound up over high inflation rates and the effect it has on mortgage rates and so on. I couldn't care less. Why? Because even when inflation was at 10%, which it wasn't that long ago, it was at 10%, the bottom line is you borrow at today dollars, when you take a mortgage from a bank, and you're paying it back, I don't know, maybe over 30 years, but because of inflation, what does inflation do? It erodes the value of money, right? If you had a $100 bill today and 10% inflation, in a year, you'd have that same $100 bill, but it wouldn't be worth $100. It'd only be worth $90. So you're borrowing today dollars, and you're paying back lesser value tomorrow dollars, and the bank will never come after you to make up that difference. It's the only way to beat the banks. It really is.
I mean, inflation has, in my lifetime, really only happened here after COVID, and it's been. When they said that inflation was 8% or 7.5%, whatever the high number was, that's an average of things. Real estate for a couple of years was 30%, or like one year was 30%, another year was 20-some%. So like the houses that I had doubled in price. Yeah. So what you were talking about is, people are complaining about it, and I'm just going, well, I just got wealthy. More wealtty. Wealthier.
I mean, I've been investing for longer than I think most people have even been born. And I will never forget my first investment property. It was 47 years ago. And I bought it when I was 2.
I wasn't born.
But I thought I was so cool, so smart. I got a 9.5% mortgage. And then I saw in the years that followed, mortgages at one point were 18 to 20%, So when I hear people get wound up about 7%.
Yeah.
It falls on deaf ears.
Well,
But, as we're saying, the benefit is we only really typically talk about the cash flow, but when you add up all these different ways you're making money with real estate, my goodness,
Yeah.
why would you do anything else?
It's hard. It's hard. I mean, for sure, the majority of everything I've ever done is real estate, and I can see it and touch it. It's not going to go to zero. And even if somebody told me it was worth zero, somebody's still paying me to rent it. Like that's what going through recessions, I have seen. Like, okay, my house is worth $200,000, and I have a tenant that my cash flow, let's say, is $200 a month, right? Well, then all of a sudden recession happens. Now my house that was worth $200,000 is only worth $100,000, right? But I still have the tenant that's paying me $200.
Exactly.
That's all I care about,
Exactly.
So yeah, I'm a big guy. Obviously I'm the real estate doctor. Like I'm all about the real estate. But let me try to summarize and button this all up. So you can buy in Cleveland with $30,000. What kind of credit? I wasn't clear on the credit. Like what kind of credit if you want to borrow?
You've got to be north of like 660.
So if I'm 620. Forget calling.
No, I won't say that. I'll just say that it's a little more challenging. There are lenders out there that will lend to you.
Okay.
At 620.
So
I look at it this way, Doc. Come one, come all. If you've got $30K in cash, I will get you in the game. Period.
Okay. All right. So $30,000, I can buy a property. I'm going to make 40% on my money. You're going to find a contractor for me. You're going to if I want to borrow the money, you have lenders that will lend it. If I want to refinance, you have lenders that will refinance. And I heard you briefly say you also have property managers. So we didn't talk, I don't want to get too much into it, but you have property managers that will manage
I have a third-party property manager. It's not part of my company, who I have confidence in and who I've introduced to all of my clients. The reality about property management, as you well know, is you've got to buy into what that property manager is all about. When you own the property, the moment you close on that property, you are driving that bus in terms of decision making. And that's why it's pointless, because he's very busy, to introduce him more than 2 to 3 weeks prior to the end of construction. But when I do, you get together, you have a conversation, you go over the property management agreement, make sure you're both on the same page. The tenant selection criteria is that maybe some people want to state a preference for Section 8 housing, which is, public assistance, and other people prefer to go market rent. Whatever your case may be, the property manager is a great person to talk to about that. Frankly, if something happened and you didn't like that property manager that I introduced, I won't be offended. I have no dog in that hunt, as I've said. I will help you find another property manager to work with.
Okay. So, that's the BRRRR method, turnkey. Really, it's about as easy as can be. Obviously, I refer students to you and they buy from you. So, why? This just occurred to me. Like, if I had $150,000, why should I buy one or should I buy 4 at the same time?
That's an excellent question, and I'm really, really glad you asked that for this reason. It depends. Okay? What I mean is, look, what I do that's a little bit different from other people in this business who just want to sell you a house. Yeah, I'm all about selling you the house, but I want to do it in a way that's going to help you reach your goal. I have a process that I go through with every client, experienced or inexperienced, where I look at their what I call war chest, their amount of liquid capital that's available to deploy when you're ready to pull the trigger. Not asking how much cash you have, that's none of my business, but rather, look at the war chest. Consider cash in the bank. Consider a 401k that you can borrow from. You never want to break it because that's stupid fees. But there's that. There's maybe you've got equity in your home that you can pull out using a home equity line of credit or HELOC. whatever that case may be. And there are some other ways too. But you look at that. But here's where the pedal meets the metal. My next question is always, what's your goal? What's your end game? What is it you're trying to achieve? I don't need to know the hyper-specific goal, but everybody's got a goal that gets into the real estate business or game, you know? And maybe your goal is you want your partner to be able to give up the 9-to-5 job. Maybe it's that you want to give up your 9-to-5 job. Well, that's going to take money. How much money is that going to take in terms of passive income? You know, Robert Kiyosaki, who wrote Rich Dad, Poor Dad, said very, very famously, there's only one true way to create wealth, and that's passive income. Okay? So when I understand what your goal is, what's your number? Is it $3,000 a month, $5,000 a month, $10,000 a month? Whatever your goal is, the last question I ask is, how many years are you giving yourself to achieve that goal? And I'm gonna, this is like sharing all of my secrets, okay? Because I can tell you, based on your available cash, your goal, and the time frame that you ideally would like to do it, I can tell you how realistic you are, and I can generally tell you exactly how to get there. And I can help you get there, you know? Last thing, and then, you know, I've basically shared everything. I'm a visual thinker. You know what an oval running track looks like?
Like a
You know,
dog
it's-
racing or
yeah.
a horse track?
It's
Yeah.
got it's got like lanes on it, okay? To me, the BRRRR method is like putting one runner midway along the long side of that track. When they go a quarter of the way around the track, that represents the renovation is done on the property. Another quarter of the way around, so they're directly opposite side of the track, that's the cash out refi. It's like the runner handing a baton off to the next runner, and that's your second house. Another quarter of the way around the track, and that runner, that house has been renovated. Another quarter of the way around, handing off the baton, you're buying your next house, you're into your second year. So, this is the bottom line. If you do the math, any market in which you're earning $200 to $250 a month per property, you can do the math on how many years it's going to take you to get where you want to be. Okay? Well, I've got a message for you. Come to Cleveland and cut your time in half or in a thirds. You know, because, you know, if you said to me, Doc, I want to make $5,000 a month passive, and or $10,000 a month passive, and I want to do it in 5 years. If you've got $30,000 cash, I can get you there.
Wow, that's powerful. So if people want to buy from you, we're going to put your contact information, like, and you'll talk to, you know, like how's the process work? Like if I
Okay.
want to buy from you, what's the process?
You know, I've got a link, but if you don't have the link for my calendar, send me an email. Send me an email. Also, I'm on WhatsApp.
And I'll talk to you, not like some sales guy.
Absolutely.
Okay.
And here's the thing, I don't hand people off. Okay? Well, for better or for worse, you got me. You know?
Right.
And
That's funny.
you know, I have 3 absolutes. Number 1, I don't work banker's hours, which means I live a pretty unique lifestyle. I travel a lot. I'm all over the place. I could be on the Riviera. I could be out in, you know, Southern California, whatever, anywhere in between, okay? But the bottom line is I respect that everybody's got a life and a calendar and a schedule, and I do absolutely my best, even if it means doing a call on a weekend, that I'm going to hook up and make it work for you. Secondly is I don't jam square pegs in round holes. I really don't. I mean, if something is not to be, it is not to be. And you can always count on my honesty and my straightforward, transparent self. You know, if you're trying to do something that just can't be done, in my considered opinion, I'm going to tell you so. Okay? In my 20 plus years in this business, I've worked in 19 different markets around the United States. Not because I'm fickle, but because, as you well know, markets come and go, and you have to be nimble enough to pivot if you want to be in this business. Number two, I know it's rookie numbers next to you, but I've done over 2,000 houses myself. And number three, this is probably the number that I'm most proud of. You know, I'm not the real estate doctor, but I have mentored, coached, and guided more than 5,000 investors in my career. And that's the part that I love. That's why I so deeply care about finding out what a person's goal is. And the thrill I get from helping them reach that goal, oh my God, there's nothing like it.
Okay. One other question, and then I'll get into we'll finish with some fun stuff. How long's Cleveland gonna last?
That's the impossible question to know. But
Well, you said you were in 19 other markets. Like,
Yeah.
is there a
yeah, no, I mean, we are constantly monitoring some key KPIs, if you want to call them that, key performance indexes. You know, we're looking at population stats, we're looking at unemployment stats, we're looking at the overall rent to price ratios in the market, and you know, also we look historically. I mean, I've been in the business directly for over 20 years, much as you have, you know. So I can go back and look for my own notes, you know, what this market or that market. I was in Cleveland 8 years ago for a couple of years. It wasn't anything like it is today, you know. And again, I attribute most of that to that juxtaposition of lowered home prices and healthy rents, you know.
Gotcha.
But
Okay. All right, fair enough. All right, so let me ask you, we'll finish it with some fun questions. So you are in Aruba. I like to do these Aruba questions. You just came last night. What's your favorite thing about Aruba?
oh man,
I'm going to audit it to see what you said last year.
Doc, I'm not sure if you know this, but I know what I know because not only did I live in the Caribbean back in the 80s, but I was very involved in the travel industry for a while. But I know Aruba like the back of my hand. It is outside the hurricane belt and has the best trade winds of the entire Caribbean basin. You know, so if windsurfing is your thing, I call it windsuffering, but if windsurfing is your thing, you know, you're golden. It only actually rains like 4 days of precipitation a year, which is insane to me, but that's what the numbers or the meteorologists say. Although we did have a little bit of rain, you know, actually as I was arriving, I was taking the dust from the trail at that little bar in the arrivals hall with a beer. But I love seeing the rain in this island. It's very cool. It's here 1 minute, gone the next. Very, very civilized island, very safe island, Dutch, and you know, I don't know. I mean,
That's the best.
Did I miss something?
No, I mean, I could go on and on. You can use U.S. dollars. It's got great restaurants. If you want to feel American, you can just go hang out with the tourists. If you want to feel Latin, you can just go, you know, somewhere else on the island. It's a great place. All right, last question. Business or personal, what's your big goal for this year?
Oh, wow. Can I give a business and a personal?
Sure.
Separately? Okay, business-wise, to the extent that Cleveland is still strong, I want to see, you know, at least 75% of my clients invested in Cleveland. You know, that's important to me. I want to share that wealth. It's not mine to give per se, but I can make it happen for other people. 75% is my goal. You know, it's too good for the grabbing not to share it around. And personally, my better half and I are moving to the south of France later in the year.
So that's 100%, or it's
Yeah.
it's
At this
100%?
point, it's 100%.
Yeah. All right.
You know.
You put it now. He put it out on the podcast. So next year, when he comes back, you should be living in the French Riviera.
Exactly.
All right. All right. Well, maybe I'll come visit you then.
I hope so.
All right.
I hope so.
All right, Phil. Well, thank you for coming to the podcast. I really appreciate it. Guys, if you are interested in investing in real estate for rental income, I have to second Cleveland is the spot right now. So with that being said, guys, thank you for watching the podcast and have the best day of your life.